As we transition into next week is an expiry week. VIX expiry is Wednesday morning and regular expiry is Friday morning. And then the window of weakness is open again. And so the question from there will be, well, what could derail this positive momentum U.S. equities in particular are seeing? And as we've been talking, this is a narrow rally. It's been SPY and it's been NASDAQ and it's been big cap tech. The breadth has really not been there. IWMs have not, made similar moves. S&P equal weight, I think I don't even know if it's up on the year. It may be up 1 or 2%. It's barely up on the year. So this hasn't been a broad-based rally. It's been a very narrow rally. That doesn't make it that's just, it is what it is.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
And so the question is, what could derail it? And I think I articulated this in a long post yesterday just about what could pop this bubble. And what I think is necessary is a recognition by the market and the Fed that inflation, it has not fallen as rapidly as they believed it has in the back half of 2023. And that really, because of the easing of financial conditions that we've had over the last 3 months, inflation has already bottomed. Inflation bottomed in October, month on month. Super core inflation has reaccelerated. It did in November, again in December, and I suspect it's going to do it again in January as wages remain too strong. Housing inflation is not coming down rapidly enough, and goods inflation is going to bottom or has bottomed. It's been, goods prices have been falling for 18 months. So as supply chains start to, become strained again with the shipping issues, that's going to come back. And then the last part of it would be oil and gasoline. And that there's been a very sizable move now, and gasoline is broken out, diesel is broken out, refined product margins are very robust. So look, that's I think is the tinder that is necessary. And as the market and the Fed realizes that inflation has not been slayed and that the last mile to 2% is going to be more difficult, we are going to have to price out these real rate normalization cuts. That is how I think this plays out and stops. Now, the data points we get are tomorrow and then next week. So tomorrow we get the CPI revisions. And these are the way that the BLS kind of seasonally adjusts the data, and then they do it, we get the inflation numbers every month, and then every January we get these revisions that kind of try to normalize like what actually happened in the prior year and prior 5 years, and that sets the stage for what the next year also looks like. So you get a lot of data tomorrow that will give more of an indication about whether or not inflation really did slow as rapidly as the Fed and markets perceive it to have slowed in the last 3 to 6 months. And so,
but they have an out. I mean, Yellen even today said we don't have to get prices down because wages are going up.
Yeah, look, I mean, that's, yes, I know she did say that. Waller had mentioned this in his speech in late January, and then Powell mentioned it in the press conference. It's clear that the Fed is looking at this data and they want to be sure that inflation is really coming down as the data suggests it is. And I think they are suspicious that it has come down as rapidly as it says it has. So look, I think we are biased to a potential negative surprise for markets if those revisions suggest a slower pace of disinflation in the back half of 2023. I don't think that there's much that could come out tomorrow that would make the Fed go in March, even if the revisions came. Even if the revisions came in cold, I think the Fed would say that's great. That's what we would have expected. That's what the market was saying, and we're happy to see it. We need a couple more months, and that means we're probably going to be fine cutting in May. But if the revisions come in more hawkish, I think this could set the stage for them even having to push back further the beginning of this rate cut cycle. They want to be sure that inflation really is on a sustainable trajectory back to 2%. I don't think they're sure. And tomorrow's data will go a long way to helping to determine whether or not they're going to be right or they're going to have to, wait.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.